Good day, ladies and gentlemen, and welcome to our class on volatility trading and profiting in volatile markets. So, if you already got your attention on, your headsets on, your eyeballs all glittered, we're all ready to get started. So, in trading, volatility is a measure of how prices and returns are scattered over time for a particular asset or financial product. It is the key metric because volatility creates potential profit. However, trading on volatility can also create losses. If traders do not learn the appropriate information and strategies, believe me, you can lose your shirt. Now, too many people make assumptions about volatility. The word volatility is easy to know. People read about it, people know about it, but they don't actually ever learn about it. We think because the Federal Reserve says something and the dollar shoots up, the markets are volatile. It's got very little to do with the volatility for trading. Price action is a measure of volatility. Traders are therefore trading volatility all the time and creating it in their transactions. By watching how far or how fast price moves, traders can gain insight into whether a price move is likely to sustain itself or the move has run its course. Through understanding volatility, you can create appropriate trading strategies that help to harness potential profit. Now keep in mind, anytime I mention profit, it's offset, or as the opposite side is risk. And you need to always use proper risk management. So this can be done by trading volatile assets, tracking changes in volatility to aid in selection, incorporating volatility-based technical indicators or software, or by focusing on low volatility assets. Now, volatility is an important metric for all traders, including short-term day traders and swing traders whose primary focus is on daily and weekly price movements. Now keep in mind, as short-term traders, whether you're a CFD trader, whether you're a commodities trader, whether you're a Forex trader, whether you're trading stocks, when we use that word trade in front, we don't really care what the asset's really worth. We're speculators. We're looking to make profit from the current price level, whatever it may be, to whether it may move up or move down. We're looking to take little bits of profit in any price movement. We don't care what it is intrinsically worth. We need to know that or have some basis to figure out where we stand. But if oil fell down to $2 today, we're hoping oil goes back up $2 or $1.50 as the market recovers. We don't care what oil was really worth. So how is volatility traded? You can trade on volatility across various markets and time frames. With a disciplined approach, you can learn to manage volatility for your benefit while helping you minimize risks. So here are 4 things to consider. A fundamental understanding of the forces driving each market can help you forecast volatility in a specific asset or sector. However, there are also technical tools that can be identified or can identify potentially upcoming volatility in the markets. 2 of these that we should know well are Bollinger Bands, and we have a whole 1-hour course on Bollinger Bands. But remember, with Bollinger Bands, they're using standard deviation, which is a statistical measure, on either side of a moving average. And the narrower the bands, the more contrite the market is. As those bands widen, the market is increasing in volatility. And one of the best trades with Bollinger Bands is the Bollinger Band squeeze. When the price is all squeezed inside a little lower band, we know at some point, we don't know whether it's going to break up or break down, but as those bands widen or start to widen, we know the market is getting more volatile. And then we also have average true range, ATR. And it's an interesting indicator. It averages the market's price range over time. And you can add this indicator to any market over any time frame. Volatility is the likelihood of markets making major short-term price movements at any given time. High volatility markets are generally unstable and prone to making sharp upward and downward movements. You want a perfect example of that? Watch Bitcoin or cryptocurrencies. Most highly volatile assets typically come with greater risk, but are also greater chance of profit. So keep in mind, greater risk, greater profit. This is why most traders try to match the volatility of an asset to their own risk management profile before opening a position. Major driving forces of volatility can include market sentiment and imbalances in supply and demand, both of which can be influenced by economic crisis, political development, company announcements, and micro indicators and so on. Just start to think, what happened to the commodities market and what happened to the dollar the minute the Russians invaded Ukraine? What's happened to oil prices? What's happened to natural gas prices? These are imbalances in the marketplace. In volatile markets, profits can suddenly vanish and turn to losses. So consider ways to lock in more gains when you can. One approach here would be to lower the profit targets for parts of your position. In other words, say, take 3 positions on gold if you think gold is going to go up, but the markets are volatile. So take a profit on one of your trades in a shorter term, a lower price. Tighten your stop losses. Keep another portion until it goes up. Constantly sharpen your stop losses, and let the third trade continue to run. But having a plan is important. Volatility is arguably the most misunderstood concept in the investing community. While professional traders live on volatility, many beginners in the market don't know what volatility is and how to trade on it. Without volatility, there would be no significant price movement in a short period of time, and traders would have a hard time to catch profitable trades or to make profit at all. That's why we'll cover the importance of volatility in the following lines, and we'll show you what it is and how to calculate volatility and how to take full advantage of it. So volatility is a statistical measure of the deviation of returns for a investment or financial instrument. Simply put, volatility refers to the amount of price change over a given period of time. The more the price tends to change over a given time span, the higher the volatility of the financial instrument. A highly volatile asset would move more erratically and experience impressive increases or dramatic falls. Now take, for example, Bollinger Bands. Bollinger Bands uses a center moving average and a calculation of 2 standard deviations above and 2 standard deviations below. And a standard deviation is a very complex mathematical statistical guide, but it really takes the mean, which is the moving average, and then takes the variation or the deviation from the open, the high, the low, and the close of each time frame from that moving average. And then it squares, it cubes, it turns it over round and round and round abouts and gives you a number. But what it's doing is measuring the distance of each price move at each time segment. The less volatile asset, on the other hand, would hardly move at all. Combining financial instruments with different volatilities can be used to diversify the investment risk in a portfolio. Also, for instance, I'm retired. I'm an old guy. Okay. So my retirement portfolio is set with very little risk because I'm not looking to make money in the markets now. I'm looking for my retirement portfolio to pay me back cash. I've moved from growth investing to cash investing because I just want dividends back. I want cash back because I've climbed the mountain already. Okay, so you have to decide where you are, but that's for investing. Trading is different. Once you get into the arena of trading, you're in high risk. You're looking to make money. The term implied volatility refers to the estimated volatility of a financial instrument's price in the future. Implied volatility is commonly used in options pricing, or increases during downtrends or decreases during uptrends, because market participants usually consider bearish markets as riskier than bullish markets. High volatility. Okay, high volatility is usually associated with riskier investments. Since volatility can work for or against a trader, trading a very volatile financial instrument should be taken on with caution. Say, for instance, in the Forex market, major pairs which include the US dollar are either the base currency or the counter currency usually fluctuate a very small extent. Look, we may go, whoa, look at what the euro did today. It moved 50 pips. That's a big move for the euro, right? Well, if you were trading millions of dollars, you might have made some money. That's why we use leverage anyway. But it's a small amount of volatility in the market. Because remember, a pip is point in percentage. It's the fourth decimal to the right. It's a small move. And so Forex market doesn't really move that much, except when you go to the exotic and the other pairs like the Turkish lira or the Mexican peso. But so we have to know what the volatility is for the asset we're looking at. While trading high volatility financial instruments can be lucrative, traders need to pay attention to proper risk management when doing so. Using stop losses is mandatory when trading on high volatility in order to have potential losses under control and avoid a margin call. Please always avoid a margin call. If the price moves a lot in a day, especially with lots of volume, this means that a trader can enter and exit the positions easily. This is one reason why volatile stocks are so popular for day trading. Big stocks, big currencies, and all CFDs, they are always liquid, but you should always be concerned in a volatile market and liquidity. So a volatile stock is one whose price fluctuates by a large percentage each day. Some stocks consistently move more than 5% a day. That doesn't mean they go up 5% a day. They move. They might jump up from 220 to 227, fall down to 196 and end up at 225. They are volatile. They're moving in both directions. Volatility doesn't mean that it closes at a 5% increase. But a volatility trader can seek out either a consistent volatile stock or one that is simply showing large movements. So for instance, Tesla is a completely volatile stock because Elon Musk is constantly tweeting, he's constantly talking, constantly doing weird stuff. Makes the stock volatile. When day trading volatile stocks, you can set up a 5-minute chart and wait for a short-term trend to develop. For day trading, a 10-period moving average will often highlight the current trend. And it's easy. Look for a market that has found a top and a bottom in a range and trade that range, because you can isolate what the high price and the low prices of that stock and then the volatility going in each way, and you can trade that volatility in a short-term trade to make some good products. So you put your stop loss above the volatility, take your target point down here and enter your trade in between and let it fly. A day trading strategy could be used for any stock that is trending, but it tends to produce more favorable results in volatile stocks because the larger price movement means that the target move is more likely to be reached. Now, a dynamic strategy is to use trailing stop losses, such as a 20-period moving average, which allows the trader to capture large trends should they develop. They should then exit the stock price and when the stock price touches the moving average indicator. So as a guideline, when a major stock index such as the S&P is experiencing above average market volatility, the individual stock within that index will also see more volatility. Now, if you look closely, you can see that some currencies and currency pairs are more volatile than others. You must have heard of the term safe haven, which refers to the currencies like the Japanese yen, Swiss franc, and the US dollar. On the other hand, emerging market and exotic currencies such as Turkish lira, Mexican peso, Indian rupee, and the Thai baht are considered more volatile than the safe haven currencies. Or imagine, how much do you really think in a day the Australian dollar, New Zealand dollar move? Very, very little. They're not volatile. The two countries, the two economies stay pretty much parallel. So depending on your trading strategy and your style, you can always find a currency pair that will suit your trading technique. In simple terms, volatility refers to the price fluctuations of an asset. It measures the difference between the opening and closing prices over a certain period. So for example, a currency pair that is fluctuating between 5 to 10 pips is less volatile than a forex pair that fluctuates between 50 and 100 pips. Now, to understand the relationship between market liquidity and volatility, you must understand what liquidity is. Liquidity is the measure of how quickly and easily you can buy and sell something in the market. If you wish to buy 100 ounces of gold, there must be a market participant who is willing to sell 100 ounces of gold. In today's market for CFD and Forex trading, there's always liquidity. Okay. Cryptocurrency, major ones, there's always liquidity. But when you go down to these smaller digital assets or the smaller, less exotic, more exotic currencies, the less the liquidity is. That means you may not be able to get in or out at the price at which you are expecting or wanting. So a breakout happens when the price of an asset moves beyond support and resistance levels on a trading chart, which indicates a new trend direction. One way to measure volatility breakouts is through technical indicators such as ATR. ATR tracks how much an asset typically moves in each price candlestick. So it's constantly measuring the movement in open, high, low, and close in each candlestick. And it'll let you know if a breakaway or breakout is about to occur. So ATR and Bollinger Bands are great indicators to let you know when volatility is increasing and when volatility is decreasing. So as we've discussed, the average true range, ATR, is a particularly effective tool for tracking how much an asset is moving on average for each price bar. And the ATR works no matter whether you're looking at a small time frame or longer time frame. So you can actually see the crossovers in the ATR predicting the shift in volatility and the movement shift in price movement almost before it actually occurs on the charts. Now we also have the relative volatility index is another indicator that analyzes the direction and volatility of price. It's the bottom indicator shown on chart we'll go back to in a second. And when the indicator is above 50, this means volatility is on the downside and vice versa. So you can combine that and put it on your charts with ATR and have a nice piece of information flowing to you steadily. And then what is quantitative volatility trading? Well, it's a little bit beyond me, but it shouldn't be beyond you. Because today we have all types of computer programs and algorithms to exploit small changes in volatility. The use of software means that a strategy can be implemented on much shorter time frames and more trades can be taken than what is possible for a human. For example, a computer can place trades in milliseconds, potentially placing hundreds of thousands or hundreds or thousands of trades per day for tiny profits. Well, we don't need to do that, but if you want to do high frequency trading and taking those little pips and the little bits of volatility in each direction, it's a good way to trade. So you can think about finding a program or finding a piece of software or a robot that'll help you do this. Now, remember, trading leveraged products in a volatile market can be risky. But the fact is, if an unleveraged Euro USD position moves 1%, or an unleveraged stock moves 1%, the traders make or lose 1%. So if you've got $1,000 or $10,000 to invest, your potential profit is only 1%. Well, what's 1% of $10,000? Well, 10% would be $1,000, 1% would be $100. So you're risking $10,000 to make 100. But if you're using leverage at 10 to 1, now that 1% turns to 10% of your capital. Now, remember, it also mirrors your potential loss, but we can mitigate loss by using proper risk management techniques and stop losses. So while traders like the chance of increased profits, opening an unsuccessful trade using leverage can be catastrophic, and volatility increases the magnitude of the problem. For this reason, you should always trade with a stop loss or exit points in mind. Now, volatility trading has the potential to provide big rewards while using leverage, but also big losses. Whether trading a volatile market or not, risk management is paramount. Stop loss orders should always be used, and the need for the execution tools increase as volatility or leverage increases. Simply put, there are many ways for you to have an exciting time trading the markets. While every methodology laid out here has its merits, they also have the potential for unmitigated disaster. Being laser focused on managing risk and making sure that your spontaneity doesn't turn to recklessness is a vital component to trading for the long term. So that's it for us today. Now remember, we have whole 1 hour classes on ATR, on Bollinger Bands, on individual indicators. Okay, we have 1 hour classes on all the specifics. So if you're ready, go look at our videos or sign up for our classes. Thank you very much for joining us, and have a great trading day.